Hi everyone and welcome to this financial modeling podcast valuation special video. Joining me today is David Thompson. He's been on the podcast previously, so he needs no further introduction, but he is a valuation specialist and been working with valuations models for some time. So David, my first question to you is this. Through the financial modeling podcast, I get lots of questions around valuing businesses, and a lot of them are startups. And I think a startup is maybe a little bit more difficult to value than a larger company. We'll get your thoughts on that as well. But what are the sort of things that you've seen that you might find in a startup that you wouldn't necessarily find in a larger company? And just off the top of my head, one of them might be sort of that social network where startups, let's say it's a small restaurant business, they rely on social media channels to actually generate a lot of their business. And that's where a lot of their fan base comes from.
Yes, it's a good question. So we do a lot of, over the years, we've done a lot of large company valuations, and for global super funds to go into their portfolios, so big infrastructure assets, and then also mining companies, generation companies, and even down to the small companies. So one of the things that's interesting that I found in the small companies, there's a lot of intangible assets potentially in evaluation, and that's what people are buying is into the future. There's a lot of startups at scale, so there's a lot of pent-up value in what they're doing. And a lot of IT companies and technology companies, for example, as you know, haven't turned a profit for a couple of years, and yet they're worth an enormous amount of money. So if you think about a classic valuation approach, an option methodology, you go through a range of things where it's the cost approach, so to value something based on the cost, market approaches, and there's a whole range of market multiples, as you might know. So EBITDA multiples, EBIT multiples, PE multiples, etc. And even there are some where you do enterprise values to revenue or enterprise values to a whole range of others where they use industry rules of thumbs. So it might be an enterprise value per megawatt for a generation unit or a wind farm or a solar farm. So there's all these sort of market approaches, and then there's the income approach, which is classic DCF, discounted cash flow analysis, using CAPM and things like that. So if you think of all those, the way you picture that, how you understand the value of something, when you're doing a purchase of a company and a merger and you're doing a purchase price allocation, you then go through the process, the accounting process of allocating all that value. And where is it? So you pay $100 for something, or $100 million for a company, and you look at how you allocate the value, and you might have tangible assets, let's say $50 million. So where's the other 50? So this is a small startup company, it's worth a lot of money, but why? It might have $10, $20 million of tangible assets, and someone's paid $100 million for it. So then it gets into all those intangible assets, and this is where the things you start to look at. Getting a little bit back to your question, so trademarks, trade names, customer relationships, customer contracts, patents and technology software. So I think what you're referring to in that case could be a lot of it comes through word of mouth, but that's to do with customer relationships. And then it flows through to, you can attach a trade name to that, can't you? Or a brand name or a trademark. So once the word of mouth gets out, that this little corner shop or the small company is, well, it's the brand that gets that flow, but it comes through the customer relationships, but also then the mouth as a result of that. So I think that's sort of, you can sort of step through the process and work out where that could be coming from.
That's fascinating stuff. David, before we step into the financial model, because I know you've actually got a couple of valuation models to show us in the video, let me ask you a question that I often get asked, and it's how come these massive technology companies, and we've seen it so many times over, that are loss-making can be worth so much money? And of course, it's a little bit counterintuitive if you think, well, this company not even generating a profit. In fact, they're generating a massive loss, bigger loss this year than they did last year, yet they're worth more. How can that be? And of course, we've seen it in Netflix recently, where a company can almost just flick the switch. Those companies can flick the switch and suddenly become massively profitable.
Well, yeah, good question again. So I look at the way the market moves, and a lot of it's about perception in the market and expectations. And mining companies do this a lot. You see a lot of small mining companies, particularly the research ones, exploration ones, they publish reports quite often. So they strike a well or they find something in there or the reserve. So what they're trying to do is prove up the probable and provable reserves. And so the bigger reserves, the more drilling they can do, the more they publish, and then therefore the potential for future economic value comes as a result of people see that, yes, there's little money, they've spent a lot of money, they've actually made no profit, they're spending money hand over fist, they keep raising bigger and bigger amounts of equity to keep drilling, and then the potential is they found that well, but it's going to take a number of years to be able to drill it and then bring the product to market and sell it. And then you basically the value is all about, hence the income approach, the DCF, perception of future value. And you can value that via assumptions around the volume that's sold, the price it's sold at, and the margin they're going to make on that product. And so the same thing applies to the technology companies. You know, we did a recent company, helped a company out, small company, doing very well in Australia, growing massively in Australia, but also starting to win international contracts and growing. And therefore, it's that customer base. You can imagine the 25 million customer base potential in Australia and 300 million in the US, for example. So if you can break into that market and sell the same product with the same market share and concept and take-up rates, you can see exponentially the value just jumps. So we, again, do the valuation for them. We've built the financial models to enable them to understand the market shares, how they do that, what they have to invest, and the take-up rates, and then the costs associated with that, the margins. And basically, it's an economies of scale game.
Fascinating stuff. Well, let's have a look at some models. I know you've got some stuff with us to share with us today. And let's also have a look at some of the most heavily negotiated aspects, right? And I'm pretty sure discount rates and how we value these cash flows and what we forecast are going to be exceptionally highly negotiated points when it comes to any of these valuations.
Yeah, thanks, Max. What I'll do, rather than showing a financial model in terms of valuation model per se, I just want to talk and show a couple of examples about things that I've come across that I find other companies are missing internally, and some external advisors that are brought in to do something independently. So, give an example. We valued a very large infrastructure business, have done for a number of years, and built some financial models for them. And when I was first brought in to do that, they had advice from one of the big accounting firms who had built the base financial model. They had separate advice on the cost of capital from another separate Big Four accounting firm. And then they had a separate advice again around debt from a debt provider and where they borrowed the money from. And whilst all pieces of separate pieces of advice were technically correct at the time the advice was given, the model, the advice, and the separate advices were never connected properly, down to the basics around bringing it back to real terms and how they interconnected. So just be at a high level, simple level. Let's say someone said the cost of capital was 10% post-tax WACC. And that's true at that time. But then when you build a financial model, as you know, you want to play around with sensitivities and scenarios and change growth rates, change CPI, change discount, all that sort of stuff, change revenues, gross margins, and then you get that disconnect. So the values, the reason I was brought in is the values were going all over the place as the CFO was reporting values up to the board. And they just didn't understand why they were getting all these changes, because they were changing assumptions, but some things were locked, and therefore there wasn't disconnect. So I think the first thing I'd like to do is I might share the screen, Matthew, is just show a simple example of what I think is important to understand. I'll try to keep it very simple, but I just wanted to lay this out so that your viewers can get a bit of a handle on and understand how values are connected, whether it's real, before tax, weighted average cost of capital, whether it's nominal, so it's got inflation built in, whether it's before or after tax, and with and without debt. So just to give you an example, this simple little cash flow, it's a valuation. So to get something, and I think I'm trying to explain it this way. So if you think of something that has a starting value of $1,000 and in perpetuity, in the discount rate is a nominal before tax discount rate of 10%, then you should expect in nominal constant terms $100, because it's $1,000 at 10%. Well, the same thing is if you invested $100 per year forever and discounted at 10%, it'd be worth $1,000. So this just tries to show what that means. So again, I'm just trying to keep it simple. So it's a $1,000 starting point, 10% nominal pre-tax discount rate, and $100 nominal cash every year. And to take it out over 1,000 years. And you'll see the present value of those cash flows is $1,000. The same value is $1,000 as long as you discount those cash flows at the inflation rate, CPI. So that then gives you, but then you discount those future cash flows, which are continuing to be discounted over time at the discounted rate of the real discount rate, 7.32% in this case, and the present value of those future cash flows is also $1,000. So then you say, well, how does that change? And you'll see here, I've just taken out the growth rate. So now I've got, if I take out the inflation rate, you'll see that everything holds true. So there's $100 constant nominal, there's no inflation, so the real and nominal are the same rates, and there's no growth. So there's no growth, so everything's the same. If I put inflation back in, you'll see that you then have to discount it at the real rate on the real cash flows, you get the same NPV. And when I put the growth rate in, so now I'm going to grow these cash flows. So now my $100 nominal constant is growing at 3% per year. And then I discount that at inflation as well. And what you'd expect is, because but you're going to discount these at 10%, so the value should be higher because it's growing in nominal terms now. And so this is one of the tricks. This is where people get caught up. So if you model that out for 1,000 years, as I've done, you'll see the values hold true. The 1,000 equals 1,000, 1,400, 1,400. If I bring that back to 100 years, it starts to get a little bit wonky. If I bring it back to, say, 20 years, you start to see the value. That's not $1,000 now. The NPV of future cash flows, because it's only 20 years and there's no terminal value. So the shorter the time period, obviously, the present value of future cash flows only goes to 10 years in this case, so there's $600. So there's no terminal value. So what you've got to look at building in is a terminal value to take care of that.
And,
so
and let's talk about the terminal value for a second. I mean, a terminal value, quite simply, is just we're saying at that point in time, at 10 years in the future, that terminal value really encapsulates all future growth from that point on, discounted to that point in time, 10 years in the future. And it's a simple concept, but of course, exceptionally complicated to do. And of course, can vary significantly, because never mind forecasting now 10 years into the future, we're now forecasting past that.
Correct. And that's exactly the point I was trying to make here. So what I try to do is just show that in the top section is, if you model it right out for 1,000 years, as long as you can, then it all holds true. So at 1,000 years, it all comes back to $100 and $1,000 NPV, so we're right. And what I wanted to do down here is show the same thing again, is that when you do model only for, in this case, 15, 16 years and have a terminal value, it's really important to understand how to get that terminal value to be modeled correctly. And I'll just try and highlight this. So you see that the value PV is the same 1444 and done over 20 years, and people make a lot of mistakes in this area. So to get that terminal value with the growth rate to come back to a point in time and then discount it back to get the same present value in today's dollars as doing it over 1,000 years, you'll see the formula is actually picking up the nominal cash flow. Then it's lifting that cash flow by 1 plus the nominal discount rate, divided by 1 plus the nominal growth rate. But the nominal growth rate's actually, this one up here, it's actually the real growth rate times 1 plus inflation. And it's subtle, but people miss it. Yeah. And if you don't do that, then mathematically, if I change that and get rid of the inflation out of that formula, you'll see that went to 1428 instead of 1444. So it just shows you, depending whether you do a 5-year model or a 10-year model, that terminal value can have a big impact on the value that you're explaining to somebody.
And so I think I just want to highlight something else also that you've said here, David, because I speak to a lot of startup businesses, and what they say is, we're going to keep our costs to our clients. So we're going to keep our sales price the same over the first 5 years while we build up a client base. And the next thing they sometimes say to me is, therefore, our profit margin is going to stay constant over the next 5 years. And I always say to them, no, that's almost 100% not true, because you might be charging your clients the same over the next 5 years, but I'm pretty sure your costs are going to be increasing at least by inflation. So in fact, your profit margin is going to be decreasing over the next 5 years. And that's absolutely fine if you want to employ that strategy. It's a strategy that often or can work very well, but you need to be cognizant of the fact that your profit margin is not going to be staying the same just because you're charging your clients the same. It's decreasing because your costs will almost certainly be increasing by inflation.
And look, that's also a good point. So the question becomes twofold. One is, yes, can you continue to increase prices in line with your cost base? And if that's, so average weekly earnings, as you know, generally increase faster than CPI. So can your prices increase accordingly? Do you get economies of scale by selling more? So where you're making the margins? Do you have multiple products, some are more profitable than others? So there's a whole lot of things go into making that understanding around the cash flows, profitability, and then through into the cash flow. So just one last thing on that, Matthew, and then of course it comes into life cycle. So yes, you might say for the next 5 years, I'll continue to charge that, and you've got the cost increases. But of course, as you said, your competitors then are not standing still either. So the competitors are then trying to do something about pricing and grabbing margin share. So your cost might be going up, and you might in fact start to lose margin share. So after you've put in some big, you put in bigger plan, you expected the growth to come, and it doesn't happen. Travel agents, for example, right now, could you imagine what the travel agencies and the travel all around the world are going through, airlines and etc. One last thing I just want to explain on this, just a simple little mathematical model here is I also get this mix up between what's a calculation for cash flows around terminal values, and do I use a growth rate, or do I use a market multiple or a DCF? So one of the things I wanted to show here is just a simple little equivalent multiple calculation to get the same understanding. So when it comes to growth rates and what the multiple is, if you calculate it correctly, the nominal WACC minus the nominal growth rate gives me a rate, and that rate is 1 divided by that rate, gives me a multiple, and that multiple at 14.44 times my revenue gives me 14.44, which is the same as that. So you'll see if I start changing discount rates, I change growth rates, it should all change accordingly. So that's really important to understand, is that again, someone will make that disconnect that says, a big company is trading, or comparable companies are trading at, say, 12 times multiple, and that's what my terminal value should be, because that's what the current ones are. But if you're going out for a number of years and then you're starting to play around, as you said, you're starting to say, well, what if the growth is more like 2% as opposed to 3%? What if the inflation is higher or lower? So as you start playing around with these rates, the multiple, because it should be directly related to the growth rate and the discount rate, is not the same number. It should flex with your assumptions. Otherwise, you will not get the same correct value come through. So that's just another one I wanted to point out to hopefully that makes people understand. It's really important to understand how that relationship holds true over time under varying assumptions.
Important stuff. David, The question I've got here, and it's one I often get asked as well, is as any type of business, when I'm valuing my company, what do I use? Should I use a DCF type model? Should I use a multiple valuation? Which approach should I use? What do you recommend here?
Well, again, a lot of, I think it depends on whether you're in early startup or whether you've got a mature business or whether you're in a declining business. So if you have a business where you can reliably forecast cash flows, then I think that's obviously the most robust. And a lot of people have a different view on that. But you can understand the robustness comes in the form of making sure that you can stress test all the various assumptions around it. You can certainly stress test multiples, but I from a valuations perspective, you generally would like to rely on the DCF income approach and then cross-reference it against all these other market multiples. So does the value you're getting, so in this case is $1,320 million, is that when you convert that to $1 per megawatt for a wind farm or a solar farm or a generation, does that make sense compared to comparable trading multiples? In other words, what are companies currently trading at, or comparable transaction multiples? In other words, what have companies recently sold at as a comparable multiple? And that can be a price earnings ratio, an EBIT ratio, EBITDA, or an EBIT to EV ratio, or even in the regulated businesses, Matthew, we talk about regulated asset base. So when companies trade in that space, you do an EV, enterprise value, to RABs, or an EV to RAB multiple. And let's say they could be sometimes between 1.2 and 1.56 times the regulated asset base. So again, DCF, and then cross-reference it to all these other trading and transaction multiples. And even cross-reference it to cost base. So, you do what's the optimal replacement, come from the regulated businesses, Matthew. There are a whole lot of terminologies, but if you think of what is the current replacement cost for an asset, and you think of a big dam or a power station or a transmission line, there is a current cost to replace it. Then you can optimize that cost. So it's not exactly, but you have to look at what you're replacing so you can optimize it. And then you've got to depreciate that to the same scale and length of life in this thing. So you get optimized appraisal value, depreciate, optimized replacement costs, and written down replacement costs. So there's all these variations around making sure that how something is benchmarked. So when you do the DCF analysis, remembering you're coming back and the future cash flows is based on what that is worth today as a written down value. So again, cross-referencing it to cost-based approaches as well.
David, the final thing I want to touch on in this model is the fact that your nominal WACC after tax is lower than your nominal WACC before tax. And it's quite an important point that I think a lot of startup founders should note. And of course, not all of them can access debt or formal debt, but of course, interest is a tax deductible expense that can actually lower your cost of capital.
Yes, absolutely. And again, that's probably the one thing I'll do, Matthew, if you don't mind. I'll flick to this other screen. Am I still sharing screen 2 with you? Is it now this different model? Model now? Okay. So look, it's quite complicated on the screen, but I'll try and keep it very simple. So this is the left-hand side here is a discount or a WACC calculator. And so built-in inflation, market risk premiums, I get my asset beta, the debt beta, the cost of gear, the level of gearing I've assumed in the discount rate, which gives me my debt equity structure, the tax, which gives me my equity beta. And then I model up from that the risk-free rates to get my cost of equity, and then weighted average between 40 and 60. So 40% debt, 60% equity. So my equity is at 18%. My debt's at 7.5%, which is a margin over the risk-free rate of 2%. And I get 40%, and then so my weighted average cost of capital in this case is 13.1. So what I wanted to show here, and try and keep it simple again, but it's got a lot of information, but just try and keep it a bit simple. So I've got 3 little charts here. So whilst I've calculated my cost of capital, one being the cost of equity, 18%, based on a 40% debt to equity ratio, and a set of assumptions around the beta of the asset. And the beta of the asset is the risk of the asset. So you and I have the same asset, but we can gear that differently with different debt and equity structures. But the risk of the asset hasn't changed. So what you asked was financial engineering, financial gearing structure. And so what I plotted here is 3 charts. One is net debt to net debt plus book value of equity, net debt to enterprise value, and debt to enterprise value, and net debt to enterprise value. And then these are just the simple averages. And you'll see here, and this is because I've just played with the debt to get different types. So I've borrowed debt, paid it off, borrowed a bit more, paid it off. And you can see here, I've assumed 40% gearing in my cost of capital. So I'm charging all future equity at 18% based on that assumption. However, you can see here, my debt and equity is going all over the place from 10 to 40, back to 10, up to 40. So my equity isn't constant. The debt to equity portion isn't constant over time. So this is a simple average, but it's not constant over time. So what I wanted to show here is, and again, hopefully your viewers can see this. So this is just nominal pre-tax WACC, real pre-tax WACC, nominal after-tax WACC, real, nominal before-tax equity, so debt's taken out, real, nominal after-tax equity, and real. So there's all the corresponding rates, and these are the IRRs based on this version of the model, and so they can see my spread. And what I want to point out is this. So whilst I've goal seek to basically get the NPV to be 0, so this is the NPV, so targeting a nominal after-tax equity, and I could choose which basis I want to run the model at. So I've got a nominal after-tax equity of 0, And so what I want to show is two things. One is look at the difference between the real and nominal. This is the delta between real and nominal, and it's basically almost zero. So it just goes to, and the subtle difference is I do a real detailed discounting cash flow, but the inflation rate to discount change between nominal and real is at a set assumption over time. So it's just a slightly day discount rate versus the assumption around inflation built in over time. So it gives you very small, basically it's zero difference between real and nominal. But this is a nominal after-tax value, so the value is zero, NPV is zero. However, the nominal before-tax equity is negative 43. And why is that? Because this is after-tax equity and this is before-tax equity. So you'll see the value, the NPV is zero after tax, but the value before tax is negative. And why is that negative? It's because I've assumed 30 cents in the dollar in my tax and my discount rate, but my actual cash tax paid is going to be different, right? So I'm going to get a different value between nominal after-tax equity and nominal before-tax equity because the rate that I'm using to discount my nominal before-tax cash flows is based on a simple assumption, but my cash flows are based on actual cash over time. And so the same thing applies with debt. So here again, this is before nominal after-tax equity and nominal before-tax equity. And so you'll see here again, the difference here is this is with debt taken out, and this is nominal after-tax WACC. So there's no debt, so it's based on an assumption. But you see, because my debt is actually slightly lower, then I'm hitting my cash flows with too much discount rate because the actual debt is slightly lower than the assumed debt. So therefore, to get to NPV zero, so my pre-debt, as in WACC, cash flows are going to give me a slightly higher value because the discount rate is, the debt assumption is 40, whereas my actual debt is lower than that, and I'm hitting that. So if I change that, what happens to my cost of equity? If I change that back to say 25%, my cost of equity drops down to 16%. Yeah, and so then I'd be hitting my cost of equity accordingly. And you'll see the NPV now is almost exactly the same between WACC and nominal after-tax cost of equity. So again, it's technical, but I think it's really important just to show your viewers that this is all connected. Cash flows, discount rates, real, tax, debt, terminal values. It's all connected. And I think you need to understand that to be able to understand how to value something appropriately.
Absolutely. Really great stuff, David. My final question to you is actually this, and I get this asked this question a lot from different financial modelers and even the startup founders. The question is that often it's said, and we can see it in the models, that the cost of equity is more expensive than debt, and equity is more expensive to debt. And if you go to a startup founder and you say, what would you rather have, equity or debt? They'll say equity, because I can't afford debt. I can't afford scheduled payments. I'd rather have equity that's patient and helps me grow. So to a startup founder, it's a little bit confusing as to why equity would be more expensive than debt. It seems much more preferable and in fact potentially cheaper, especially in the short term.
Yeah, I think particularly in startups, Matthew, you will know angel investors, small investors, that stuff. When they're putting their own capital in, A, the owner, and B, angel investors or high net worths putting into startups, they're not expecting 10%, 15% returns, right? They're expecting 50% returns in equity. Because they will invest in 5 or 6 startups and 3 or 4 of them will fail. So they want 50, 60%, 100% return on their equity over time. And they will have a plan of saying, I'll put in $5 million, but I expect to get $10 million out in 3 years' time, 4 years' time. And then because you then bring in another tranche of equity, or you reinvest, or you get out, sell down, and you'll get a takeover, private equity will come in and take you out, etc. So I think in that startup sense, the expectation for equity is a lot higher than a long-term cost of equity over the whole life of cycle of a business.
Yeah, it's a great answer, and it's all risk weighted. Of course, by the time you can actually afford debt, there's a lot less risk in the business, and therefore that debt is a lot cheaper.
So if you can imagine, if you're building a new renewable energy business, so a solar farm or a wind farm, and you think of where that cost is and relationship around developing that. So developers go out, grab a block of land, they look at do some resource, try and work out what the wind and the solar resource are, try and run around and sign up contracts for land to be able to put in a size. Then they try and sign up who can take the contracts, off takes, various customers, etc., and then try and go and sell that product. But they might spend $3, $4, $5, $10 million developing that, but they will want to sell that for 2 or 3 times that value. Yeah. So there's your 200 or 300%, pick a number that you want to get out of that. Someone else comes in, buys that, and then you've got to construct it. But there's risk involved in the construction. So you're taking all that construction risk and interest during construction, you take it out. So then you might want to buy that out, but then you develop it over the next 1 or 2 years, and then you might then sell out to, let's say it's a long-term contract with the solar farm for 20 years or 30 years of the life of that, and you might sell that to a superannuation fund or a fund manager, and they might expect, let's say, 7% return. So you might come in and pay the original owner 200% return. You might make 20 or 30% return in your period that you've held it as the constructor, but then the long-term owner holds it for 7. But if you think of that original contract over the life, from day one, if you built it yourself from day one right through the end, the weighted average return might be 8.2%.